Welcome to the deep dive.
Great to be here.
Today we're digging into someone truly iconic, Warren Buffett, the Oracle of Omaha.
Mm-hmm. Decades of success at Berkshire Hathaway is quite a story.
It really is. And we're not just looking at his track record, are we? We're focusing on how his decision-making evolved.
Exactly.
Yeah.
Across, 7 key stages we've identified.
That's right. Our mission here is to really pull out the core principles, the enduring wisdom behind his choices.
Because it's not just about investing tips, it's a way of thinking.
Precisely. Something investors, entrepreneurs, really anyone making decisions can learn from. We want to get beyond what he did and understand the why.
And show how you can potentially apply some of that.
Absolutely. That consistency in his approach, even as things got incredibly complex, that's what's so fascinating.
It really is a framework that just worked through thick and thin.
Okay, so let's dive in. Stage 1. The early foundations, learning the value of a business.
Right back at the beginning.
Long before the billions, he was, selling gum, delivering papers, just basic commerce.
Yeah, getting his hands dirty, learning how money actually moves, how transactions work.
And that first stock purchase at 11 years old.
Incredible. And the lesson wasn't about a quick win, was it? It was patience, holding on.
A powerful lesson early on. But the big intellectual shift came from Benjamin Graham.
Oh, absolutely, The Intelligent Investor. That book was foundational.
Graham's big idea that a stock isn't just a ticker symbol, it's a piece of a business.
And you value the business, not just guess where the price is going.
That just clicked for Buffett, didn't it? It became his North Star.
Completely. He started devouring financial reports, really digging into the numbers, looking for the story.
He became a deep reader, as you might say.
That's a good way to put it. Understanding the engine behind the stock price.
So looking back at these early years, what signs point to his developing decision-making skills?
Well, first, definitely that intense intellectual curiosity. He wasn't just taking classes, he was seeking out mentors, reading constantly.
Actively hunting for knowledge.
Exactly. Second, analytical rigor. Really focusing on the business fundamentals, not getting caught up in market hype.
Sticking to the facts.
And third, and this is crucial, learning from mistakes. Even small ones, like that first stock experience, taught him about market volatility and sticking with quality.
Okay. And what were the real benefits of adopting this value-focused approach so early?
It gave him a solid framework, a repeatable process for evaluating things. Cut through the noise.
A system.
Right. It helped him find undervalued opportunities. Others were totally missing because they were just watching the price ticker.
Focused on the wrong thing.
And maybe most importantly, it established a rational basis for decisions, took the emotion out of it, which is a huge edge in finance.
So for the entrepreneurs listening in, how do these early lessons translate? What can you apply?
I'd say, first, do your homework. Become that deep reader of your own industry, your market.
Really understand the landscape.
Yeah, and understand your own intrinsic value. What are you really offering? Why does it matter?
Good point. What else?
And seek out mentors. Never stop learning. Treat every bump in the road as tuition, a chance to get smarter.
Okay, so who was doing things differently back then? What were the competing approaches?
Oh, plenty. You had the pure speculators just gambling on price moves, no real analysis.
Short-term bets.
Exactly. Then the market timers trying to predict the ups and downs, which is, notoriously difficult.
A fool's errand, some might say.
Often, yeah. And even parts of the conventional finance world maybe weren't as laser-focused on that deep Graham-style fundamental analysis.
So, boiling it down, what are the key lessons for entrepreneurs from Buffett's formative years?
1, a strong theoretical foundation matters. Know your principles. 2, early experiences, even mistakes, are invaluable. Don't discount them.
Learn from everything.
Right. And 3, focus on real underlying value. Don't get distracted by shiny objects or the latest hype.
Solid advice. Okay, let's move to section 2. Cultivating patience and discipline.
Yes. Sounds simple, but it's incredibly hard in practice.
It really is. But it's absolutely a non-negotiable pillar for Buffett, this combination of patience and iron discipline.
He understood early on that the big wins don't come from frantic activity.
Right. It's about making a few good decisions and then waiting, letting compounding do its thing.
For decades, sometimes, which means actively tuning out the noise, the market chatter.
Sticking to the plan. You see it in how he refused to panic sell during dips.
Or his famously frugal lifestyle, even when he was incredibly wealthy. That's discipline.
And avoiding the dot-com bubble entirely, that took serious conviction.
Huge conviction. When everyone else was caught up in the frenzy, patience isn't passive waiting, it's active resistance.
Resisting the urge to follow the herd.
Exactly. And discipline provides the structure to maintain that focus, even when it feels uncomfortable or contrarian.
So what are the signs of good decision-making when it comes to patience and discipline?
Well, obviously, a consistent long-term focus, always looking years, even decades ahead.
Not just next quarter.
Right. Then emotional detachment, the ability to stay rational when markets are going crazy, up or down.
Keeping a cool head.
Yeah. And just a sheer consistency, applying his principles year in, year out, regardless of the market mood.
And the benefits of that approach, why is it so powerful?
Well, the big one is compounding. You need time for good investments to really grow. Patience allows that.
Lets the magic happen.
It also saves you from costly mistakes, those impulsive emotional trades that wreck portfolios.
Panic selling, chasing hot stocks.
Exactly. And finally, it builds resilience. Your strategy can weather the market storms better if it's built on patience.
Makes sense. How can entrepreneurs apply this patience and discipline in their own businesses?
Focus on sustainable, long-term value. Don't just chase flashy, short-term growth if it's not built to last.
Build something enduring.
Right, and practice financial discipline, strict controls, resisting unnecessary spending. That's key.
Easier said than done sometimes.
Oh, definitely. And cultivate emotional control. Business is a roller coaster. You need to handle the highs and lows without losing your head.
Who operates on the opposite end of this spectrum? What are the contrasting approaches?
Well, high-frequency traders are the extreme opposite. Tiny fractions of a second, millions of trades.
Zero patience there.
None. Then you have trend followers, jumping on whatever's hot right now, jumping off when it cools. Short-term focus again.
Chasing momentum.
And highly leveraged investors. Using lots of borrowed money often forces a need for quicker returns, which can be risky.
So the core lessons for business builders here.
Real success takes time. Rarely happens overnight. Patience is essential.
Got it.
Financial discipline isn't just about saving money. It's about smart, strategic decisions for the long haul.
Building a foundation.
And resisting hype. That's crucial. Sticking to your plan protects you from potentially big losses when bubbles burst.
Very wise.
Okay.
Section 3. The business owner's mindset. Buying pieces of great companies.
This is a really interesting shift in his thinking.
Yeah, a big evolution, and Charlie Munger played a huge role here. Right?
Immense. Munger helped steer him away from just buying cigar butts, those cheap, often troubled companies.
Where you hope for one last puff of profit.
Exactly. Towards buying pieces of genuinely wonderful businesses, even if they weren't statistically dirt cheap.
Quality over just cheapness.
Right. The key was thinking like a business owner, not just a stock picker, really digging into the operations, the competition, the management.
Understanding the actual business.
Deeply. This is where the idea of economic moats comes in.
Yes, the durable competitive advantages.
Things that protect the company's profits over time. Strong brands, network effects, cost advantages.
And he likes simple, understandable businesses.
Very much so. And crucially, he trusted good management. Once he bought in, he tended to let them run the show. No micromanaging.
Examples like Coca-Cola, American Express come to mind.
Perfect examples. Strong brands, great business models. He saw the long-term value even when they hit rough patches. Berkshire's whole acquisition approach reflects this.
Buying quality, well-run companies.
It's a move from focusing on turnaround potential to focusing on sustained excellence. A big shift.
So what defined his decision-making during this phase? What were the key signs?
First, that intense focus on understanding. Staying within his circle of confidence. Only investing in what he truly got.
If you can't explain it.
Don't invest in it. Second, a real emphasis on qualitative analysis. Looking beyond just the numbers at the business quality, the moat, the management's integrity and skill.
The intangibles matter.
Hugely. And third, a partnership mentality. Viewing management as partners, trusting their judgment.
And the results, the benefits of this business owner mindset.
It led to earning pieces of truly fantastic, enduring companies. Businesses that could grow and compound value for decades.
Less worry, maybe.
Less need for constant tinkering, for sure, because he trusted the businesses and the people running them, which ultimately led to incredible long-term returns.
So for entrepreneurs building their own thing, what are the takeaways here?
Aim to build a clear, understandable business model and work hard to create your own economic moat. What makes you defensible?
Oh, what protects you?
Right. Also, prioritize hiring and empowering great people. A-plus talent you can trust.
Let them run.
And deeply understand your competition, not just today, but who might be coming tomorrow.
Who contrasts with this approach? Who's playing a different game?
Well, you've got asset strippers. They buy companies cheap just to sell off the pieces. Very different goal.
Short-term profit, dismantling things.
Exactly. Or short-term activists pushing for quick changes to pop the stock price. Maybe not for the long-term health of the business.
Immediate results focus.
And then there are those drawn to really complex, opaque businesses, maybe hoping for hidden value, but often without true understanding.
So the big lessons for entrepreneurs from this business owner mindset.
Investing in quality always pays off in the long run. Quality businesses, quality people.
It compounds.
Right. Trusting your team enables growth and frees you up. Micromanaging kills initiative. And simplicity is powerful. If your business is easy to understand, it's often easier to manage and defend.
Keep it clear. Okay, Section 4, Mastering Capital Allocation.
Now we get into the engine room of Berkshire Hathaway.
As the company grew massive, where to put the money became just as important as picking the winners, right?
Absolutely critical. It wasn't just about finding good investments anymore. It was about smartly reinvesting the profits and deploying capital for acquisitions.
And a huge advantage here was the float from insurance. GICO, for example.
The float. That's the magic ingredient, really. It's the premiums collected up front that haven't been paid out in claims yet.
So basically, a huge pool of money they can invest before they potentially have to pay it out.
Exactly. And it's relatively low-cost capital, a massive, massive advantage. Buffett's genius was using that float, plus reinvested profits, with incredible discipline and opportunism.
How did that show up? What are the signs of his skill in capital allocation?
A clear strategy for reinvesting profits. Putting money back into the best opportunities within Berkshire, or making smart acquisitions.
Not just letting cash pile up uselessly.
No. Also, really understanding and utilizing all capital sources effectively, especially that float.
Leveraging that unique advantage.
And being opportunistic. Ready to deploy big amounts of capital when great opportunities appeared, often when others were fearful. The 2008 crisis is a prime example.
Buying when there's blood in the streets, so to speak.
If the underlying value is there, yes.
What were the benefits for Berkshire of mastering this?
Continuous, almost relentless compounding of capital over decades. It just snowballed.
The growth engine.
Definitely. Access to that stable, cheap funding via float, that's huge.
Unfair advantage, almost.
Almost. And it allowed them to make acquisitions on a scale few others could even contemplate.
Okay, how can entrepreneurs, maybe running much smaller businesses, apply these capital allocation ideas?
Develop a clear plan for your profits. How will you reinvest them to grow? Don't just spend haphazardly.
Be intentional.
Yes. Understand your own capital structure. Where does your funding come from? How can you use it best? Optimize it.
Know your options.
And be ready to seize opportunities. When a strategic chance comes along, a competitor falters, a new market opens, be prepared to act decisively.
Even if it involves calculated risk.
Right. Calculated risk.
What are the contrasting approaches to capital out there?
You see companies that pay out almost all profits as dividends. That leaves little for reinvestment and growth.
Satisfying shareholders short term, maybe?
Maybe. Then you just have poor capital allocators, companies making bad acquisitions, investing in low-return projects, maybe driven by ego.
Wasting resources.
Unfortunately common. And, of course, most businesses just don't have that float advantage Berkshire enjoys.
So the essential lessons on capital allocation for entrepreneurs.
Smart allocation is fundamental to scaling. You can't grow effectively without it.
It's fuel for the fire.
Exactly. If you have any unique funding advantages, leverage them strategically. That's a competitive edge.
Find your float.
Metaphorically, yes. And finally, that mix of patience waiting for the right pitch and decisive action when it arrives, that's vital for creating long-term value.
Wait for the fat pitch. Okay, Section 5. The rigorous, rational decision process.
This gets to the core of Buffett's operating system, doesn't it?
It really does. He's not known for acting on gut feelings. It's all about analysis, data, fundamentals.
Deep, rigorous analysis. Painstaking research, detailed financial modeling, looking at metrics like PE ratios, but within a broader context.
And a very careful evaluation of management quality, too.
Absolutely. But what's also key is his self-awareness. He knows he has biases, like everyone, and actively works to counter them.
Tries to stay objective.
Maintains incredible self-control. He famously says he doesn't make many big decisions, maybe one or two a year sometimes.
But when he does?
He goes big, with conviction. because he's done the work. You see it in their due diligence process. It's exhaustive.
And he talks openly about mistakes. That's pretty rare.
Very rare. At that level, it shows intellectual honesty and that commitment to learning.
Minimizing emotion, maximizing rational analysis. That's the goal.
Pretty much. Building a strong intellectual case for every major move and being aware of the potential flaws in your own thinking.
So, the signs of this rigorous process in action.
A heavy reliance on data. Decisions grounded in facts and analysis, not just stories or intuition.
Evidence-based.
High self-awareness, acknowledging potential biases, seeking contrary opinions sometimes,
Testing the thesis.
and that calculated risk management.
Huh.
Always demanding a margin of safety, buying something for significantly less than you think it's truly worth, just in case you're wrong.
Building in a buffer.
Exactly.
And the benefits of being so disciplined and analytical.
Well, you make better informed, more rational choices. Fewer errors driven by emotion or bad information.
Higher probability of success.
Yes. And it gives you real conviction in your decisions.
Yeah.
That allows you to be patient, to hold on through market swings, because you trust your analysis.
You sleep better at night, maybe?
Perhaps.
How can entrepreneurs bring this level of rigor to their own decision-making?
Implement data analysis in your business. Track key metrics. Use them to inform choices. Don't just guess.
Measure what matters.
Practice self-reflection. Honestly assess your own biases. Keep a mistake journal. Maybe what went wrong, why, what did you learn?
Learn from experience.
And manage risk carefully.
Yeah.
Think about the downside. What's your margin of safety in a new project or venture?
What are the contrasting styles you see out there?
You definitely see intuitive leaders who rely heavily on gut feel. Sometimes it works, often it doesn't.
High variance.
Yeah. Emotionally driven decision makers swayed by fear or greed. That's common too.
Market sentiment followers.
And sometimes overly diversified investors or entrepreneurs, spreading themselves so thin they don't deeply understand any single thing they're involved in. Dilutes focus.
The diversification trap.
Could be.
So, key lessons for entrepreneurs on rational decision-making.
Analysis is crucial, but so is intellectual honesty about your own limits and biases. They go hand in hand.
Know thyself.
Right. View mistakes as learning opportunities, not failures to be hidden. That's essential for getting better.
Growth mindset.
And maybe focus your energy. Making fewer, higher conviction bets based on deep understanding can be more effective than trying to do everything.
Quality over quantity in decisions, too. Okay. Section 6, communication, integrity, and building trust.
This is huge. Often underestimated, I think.
I agree. Buffett's success isn't just his investment brain. His ability to communicate simply and clearly is remarkable.
Especially with shareholders. He treats them like partners, explaining complex stuff in plain English, no jargon.
His annual letters are legendary for that. Insightful, but also candid and witty.
And that candor ties into his absolute commitment to integrity. It's non-negotiable for him.
He always says reputation is paramount. Lose money, okay. Lose reputation, big problem.
Exactly. Prioritizing that above short-term gain. And his transparency, talking openly about successes and failures, that builds incredible trust over time.
Decades of trust.
In finance, where trust can be scarce, that's a massive asset. His straightforwardness is exceptional.
So the hallmarks of good decision-making here. Communication and integrity.
Transparency is key. Being open and honest in your dealings. Letting stakeholders know what's really going on.
No sugarcoating.
Right. Prioritizing reputation. Understanding that trust, once lost, is incredibly hard to regain. It's foundational.
Build it carefully.
And communicating accessibly. Making complex ideas understandable. Fostering partnership, not confusion.
And the benefits. Why does this matter so much?
It builds deep loyalty. Shareholders, employees, customers, they stick with you if they trust you.
Creates long-term relationships.
Attracts the right kind of partners and investors. People who value honesty and clarity.
Like attracts like.
And it fosters a strong internal culture. If the leader prioritizes integrity, it permeates the organization. Accountability.
How can entrepreneurs apply this, even in smaller companies?
Be consistently clear and honest with your team, your investors, your customers, even when the news isn't great.
Especially then, perhaps.
Perhaps. Build your business on strong ethics from day one. Make it core to who you are.
Define your values.
And simplify. Simplify your message, your value proposition. Make it easy for people to understand what you do and why it matters.
Clarity is king. What are the contrasting approaches we often see?
Well, unfortunately, companies trying to hide bad news or spin failures,
Mm.
obfuscation,
Burying the lead.
excessive jargon and complexity.
Mm.
Sometimes it's unintentional. Sometimes it seems designed to confuse or impress rather than clarify.
Creates distance.
And sadly, leaders willing to cut ethical corners for quick profits. That rarely ends well long term. Erodes trust completely.
So the really crucial lessons here for entrepreneurs.
Integrity first. Always. It's the bedrock of sustainable success.
Non-negotiable.
Clear, honest communication builds the strong relationships you need to succeed.
Connect with people.
And remember, your reputation. It's your most valuable asset. Protect it fiercely.
Guard it well. Okay, final section. Section 7. Legacy, learning, and the future.
Even now, in his 90s, Buffett's commitment to learning is astounding.
The reading habit is legendary, isn't it? Hours a day still. A testament to continuous growth.
Absolutely. Never stop learning. But he's also thinking long-term about Berkshire's future.
The succession planning. Naming Craig Abel as the next CEO.
Yeah, ensuring stability and continuity beyond his own tenure. That's responsible leadership.
Thinking beyond himself.
And then there's the philanthropy, pledging the vast majority of his wealth, especially through the Gates Foundation.
A massive commitment. It shows his values driving decisions on a huge scale.
Aligning financial success with the desire for positive impact, it really frames his whole career as applying sound principles consistently over an entire lifetime.
It's about more than just money in the end.
It seems so. It's about the long-term impact on the company and the world.
So what are the signs of good decision-making at this legacy stage?
That ongoing commitment to growth, personal learning, organizational adaptation, never getting complacent,
Staying curious.
thoughtful long-term planning. Succession is a big part of that, ensuring the organization thrives in the future
Building to last.
and making major decisions driven by core values, like the philanthropy, acting on what truly matters beyond the bottom line.
And the benefits of this forward-looking, values-driven approach.
It keeps the organization adaptable, relevant. Change is constant.
Future-proofing.
Provides stability, a clear sense of direction that outlasts individuals,
Smooth transitions.
and allows for creating a positive legacy, a societal impact aligned with your principles.
Leaving a mark. How can entrepreneurs incorporate this long-term legacy thinking?
Cultivate that lifelong learning habit. Stay curious, stay informed. It's vital.
Never start growing.
Develop a succession plan. Even if it feels far off, thinking about the future leadership and ownership ensures long-term viability.
Plan ahead.
And integrate your personal values into your business. Think about the impact you want to have beyond just profit. What's your why?
What are the contrasting approaches we might see here?
Leaders who become complacent. They hit success and stop learning, stop adapting. Risky.
Resting on laurels.
Businesses with no clear future plan. No thought given to who takes over or where the company is going long-term. Very short-sighted.
Head in the sand.
And entities focused purely on profit, with no consideration for broader impact or ethical responsibilities. They might succeed financially for a while, but the legacy might be lacking.
So wrapping up, the ultimate lessons from Buffett's legacy phase.
Lifelong learning isn't optional. It's essential for staying relevant and successful.
Keep evolving.
Planning for the future, including succession, is crucial for longevity. Don't leave it to chance.
Secure the future.
And acting on your values, personal and business, is what shapes a meaningful legacy that truly endures.
So as we wrap up this deep dive, it's clear Warren Buffett's journey is much more than just investing, isn't it?
Oh, absolutely. It's a masterclass in rational thinking, self-discipline, building trust.
We've seen these consistent themes: value, patience, really understanding businesses, smart capital allocation.
Rigorous analysis, clear communication, unwavering integrity, they all weave together.
And his incredible success, it doesn't seem to come from complexity or trying to outsmart the market every second.
No, it's clarity, integrity, and just patiently, consistently applying fundamental truths, timeless principles.
So for everyone listening, as you face your own decisions in business, investing, life, maybe the final thought is this:
How can you take just one of these core Buffett principles
and consciously apply it today to your own thinking, your own actions, to build something more sustainable, more valuable in the long run?
It's definitely something worth reflecting on. His story is a powerful reminder.
That success often lies in the disciplined application of simple, profound truths.
Couldn't agree more. Consistency and rationality win out over time.
Welcome to the Deep Dive.
Great to be here.
Today we're digging into someone truly iconic: Warren Buffett, the Oracle of Omaha.
Decades of success at Berkshire Hathaway is quite a story.
It really is. And we're not just looking at his track record, are we? We're focusing on how his decision-making evolved.
Exactly.
Yeah.
Across, what, 7 key stages we've identified.
That's right. Our mission here is to really pull out the core principles, the enduring wisdom behind his choices.
Because it's not just about investing tips, it's a way of thinking.
Precisely. Something investors, entrepreneurs, really anyone making decisions can learn from. We want to get beyond what he did and understand the why.
And show how you can potentially apply some of that.
Absolutely. That consistency in his approach, even as things got incredibly complex, that's what's so fascinating.
It really is a framework that just worked
Yeah.
through thick and thin.
Okay, so let's dive in. Stage 1, the early foundations, learning the value of a business.
Right back at the beginning.
Long before the billions, he was, selling gum, delivering papers, just basic commerce.
Yeah. Getting his hands dirty, learning how money actually moves, how transactions work.
And that first stock purchase at 11 years old.
Incredible. And the lesson wasn't about a quick win, was it? It was patience, holding on.
A powerful lesson early on. But the big intellectual shift came from Benjamin Graham.
Oh, absolutely, The Intelligent Investor. That book was foundational.
Graham's